Hi, everyone. My name is Tara Joseph. I'm actually based in this office. And I think, like myself, I'm looking at a lot of people around me that I know. The penny is starting to drop, both emotionally and trade-wise, as to what really could be happening in the UK. And as we're seeing on the Reuters wire, whether it's trading floors in Hong Kong, trading floors in Japan, trading floors in the Middle East, as London wakes up, the implications of what happens today is really, really vast. And I think there are a few historic moments in life, but we might all be sitting together right now and experiencing one of them. I'm pleased to have a really interesting mix of panelists today to discuss, once we get over the shock of what really could be happening of Brexit, some of the implications and what we should watch for going forward. Peter Tal-Larsen, my colleague at Reuters News with Breaking Views, you all know, and also Keith Hodgson, who is an expert in terms of financial services and the financial services industry. Mike Spencer is with Deutsche Bank. He's a managing director there and head of economics. Before you were at Deutsche Bank, you were also with the IMF, so have a very global view in terms of economics. And Binay Changotia, who I've had the pleasure of interviewing before, is a portfolio manager, an asset manager, really has a sense of the different asset allocation strategies that we could be looking at once we see what is really the news out there today. So, Binay, if I could start with you, how are you positioning yourself today? Is it just risk off, or is there some risk on that we could think about?
There are two ways you can do it. You can be in the office and trying to do something, or you could be here talking to people. I chose the easier one out. Yeah, but yeah, this is like kind of almost like a binary event, and you could easily see what could happen if things went one way or the other. So you've got treasury yields going down, gold going up, pound getting hammered, Japanese yen reaching 100, I think.
I think on 300.
And of course, equities tanking. But it was always known that this is going to be a hard trade to do, as soon as you get the results. So therefore, you've got to think about what lies ahead. One of the things that I'm thinking of at this point in time is what kind of action you would expect. I think Peter talked about Bank of Japan getting together. I actually think there will be a coordinated global action to kind of soothe fears, because the crux of the matter here is dollar liquidity. The dollar shoots up, it rises significantly, and you have problems across the board. So you would expect the Fed to come out and do more currency swaps. You would expect the Fed to actually forget an interest rate hike this year. That is not in the cards to my mind. You probably expect more, I'm not a big supporter of that, but more negative rates in the euro area, probably even Bank of Japan. I don't think that helps a lot, but maybe Mike is a better place to comment on it. But yeah, so you would see some kind of coordinated action there, and then you take a view on how you position the portfolios depending upon your risk and your objectives. So there will be a lot of losers, there will be a few winners as well, and that is what we do all the time.
Let's start with that idea of global coordinated action. Keith, you are nodding in agreement. Is that going to be in the next 24 hours? Are they already talking on the phone to each other? And well, let's leave the Bank of England out for a minute, but what kind of global action would we likely see?
I think there are a number of things that are out there. I'm an accountant, and we usually say there are only two certainties in life, death and taxes. I think there's a new certainty, and that is uncertainty, which is a level of volatility that we're going to see over the next hours, weeks, and so on. Globally, trade does not like uncertainty. Trade likes certainty, and we prosper as a planet generally through trade. So I think we are going to see central banks thinking very closely and hard about this. The cost of intervention could be high, so I think people are going to think through, are there smarter ways to do this than just straightforward intervention in the markets? There's a lot of emotion in the market. We've seen sterling move 150 down into the low 130s. Is that sustainable emotion? Is all the information in the market at this point in time? I think there is so much uncertainty that most people don't know what the next hour, day, month is going to look like and what that means for their organizations. And so to believe that this is the new normal is probably naive. So I think people are going to the central banks are going to be talking, they must be talking, I'm sure they've been talking for weeks, months around this, thinking through what can be the scenarios and what can be the outcome. But I think they're going to be cautious, they're going to be measured, thoughtful. I think they need to be that way. Obviously, if there are real major economic issues that need to be addressed short term, I'm sure we'll see action. But I would caution on the side of let's work out what this really means before we make big-scale economic intervention.
Well, Michael Spencer, surely there's been a plan B or a plan Brexit that should this moment come. Are the central banks, the way banks themselves and companies sort of already ready to go and press that plan B button?
Well, I think we've already begun to see it this morning. We are seeing central banks in the market trying to provide liquidity in the FX market. I don't think they're necessarily trying to move the market the other way, because to the extent that this is emotion, it'll flip back tomorrow. Yeah. I think we know the major central banks have dollar liquidity lines and swap lines between them. If we see interbank rates spiking up and there's a genuine liquidity shortage, the infrastructure is there to solve that problem. But I think, for example, as we get into London trading time, I'd be surprised to see the Bank of England in, for example. I think if you're looking at the economic impact of a Brexit, a devaluation of the pound was a natural thing to expect. And so for them, this isn't necessarily a bad thing. For the BOJ, this is utterly in the wrong direction. But to be honest, I mean, to Binay's point, I'm not sure what the BOJ can do, right? And the ECB as well. Cutting interest rates when they're already negative doesn't look like it's going to weaken the currency. It doesn't look like it's going to impress anybody. And to the extent that politics matters for central banks, and at the margin it must, if this is a vote against the establishment, can the establishment take interest rates on deposits or pensions down even more negative? I think we're not going to see that. I think we'll see liquidity lines between central banks to make sure markets function, and just let the FX market settle where it needs to.
I'm starting already to think back to the last time we had a kind of crisis of this level. I'm thinking of the financial crisis now a decade ago. Peter, do you think we're on even territory in terms of the impact and the scale?
No, I think 2008 was much worse. I mean, I think that it was a global crisis. I think the unthinkables that were becoming thinkable at that point were on a much bigger level. I mean, to a certain extent, this is a surprise, but it's not exactly as if you can't exactly call Britain leaving the EU a sort of black swan event. I mean, we're having a referendum. It was going to go one way or the other. And I think you're right. I mean, I think there will be talk between the central banks. Apparently, there is a Basel meeting this weekend, so they're all going to be in one place anyway. So if there's any kind of action that needs to happen, that will happen. I think actually.
Maybe they have a WhatsApp group and they're like sort of sharing it.
It would be good to get on, wouldn't it? I think it's the sort of the bigger political uncertainties really that are harder to call here, and just sort of the consequences. I mean, I've had conversations in recent months with people in Hong Kong, very big people who run very big companies who've made very serious investments in the UK, who say, well, if this result goes the wrong way, then I don't know, how certain can I be about the regulatory framework for the assets that I own, and whether that 20-year contract or whatever it is that I've got is going to be honored. Kind of what happens in the next election, what kind of, if the whole relationship with the EU gets renegotiated, then what is the legal sort of political framework I'm operating in the UK over the next 2, 3, 5 years?
So the actual thing is that the result opens up this massive unknown. So Binay, how does one trade that? As a portfolio investor, let's not talk about minute-by-minute trade. Like, how do you balance out a portfolio?
So ultimately, you make kind of money by buying assets cheap. So obviously, there are going to be some winners. For example, if trade suffers to an extent, and UK is a fairly large importer of goods from across the border in the EU, like I think about 100 million pounds of annual net import of goods. The big exporters of services. So you probably have a trade where you go look for areas where companies supplying to domestic UK market will gain, maybe small caps, mid caps in certain areas where they can start manufacturing back home. You probably, maybe short some of the services sector companies because they're very large net exporter, and there's going to be uncertainty for about 2 years about how the laws shape up. So you have to do that kind of a detailed analysis on what outcomes can play out, and then position the portfolios accordingly. And of course, because we are talking about politicians, we're talking about protracted negotiations, legal issues, you can never be too sure. So you go in with some hedges in the portfolio as well. Like one of my hedges in the portfolio over the last few months was retaining a long bias towards fixed income bonds compared to cash, because the natural outcome of an adverse event would be that bond yields are going to go down significantly, right? So even though it was costing us some performance for some point in time, it's an acceptable hedge, because again, it's one of those hedges which has got a positive carry, not a negative carry, because all hedges by definition tend to be with a negative carry, right? So you got to spend a lot more time I mean, the broad macro thing is done now, but a lot more time on the nuances of what brings in the opportunity and what brings in the risks. And kind of going back to the question on what this means, maybe it's not as much about central banks, it's about the political establishment in the world. And maybe you see more fiscal efforts by G7, G20, to win back the voting community. Maybe central banks, as I said, negative rates, I don't think it helps, actually. It's negative, if you ask me. Maybe Bank of Japan goes out and buys assets. They increases the purchase of ETFs and REITs. And of course, I think you probably see more fiscal spending, to my mind.
Mike Spencer, in terms of global impact, are we now sort of, along with the political implications, seeing, I don't want to say the death of global trade, I think that's a bit overdramatic, but are we going to see this massive retrenchment from sort of a globalist, a global trade environment, people kind of retrenching back to their home bases?
Well, what will happen in the US will be far more important. I mean, it is not the intention, as far as I've understood it, of the exit camp to become an autarkic economy. They just want to rewrite the rules of engagement. I think they will find it's a lot harder to do that in terms of maintaining access to the European markets on anything like the current terms, but the UK will always be a trading nation. So we probably, from that score, have to worry more about
Trump. A lot of people want to trade with the UK. I'm thinking about the EU in particular, or...
Well, so I think both of them, I mean, the EU will have an interest in penalizing the UK. It's going to be very difficult for the UK to maintain tariff-free access to the continental European market. But they will both continue to try to liberalize trade with other countries. So I don't think this is the event. I mean, this event is more important in terms of the broader backlash against a fundamental economic and political philosophy that's driven growth over the last 30 or 40 years. In that sense, yes, it's part of this gradual withdrawal, but I still think the US election could be much more important. If you get a president in the US that comes in and says, right, I'm going to start tearing up trade agreements, that's way more important than what's happening this morning.
Okay, so if it's not trade, what, in your view, is the global economic impact of a Brexit, if indeed it does happen?
Well, truthfully, the global economic impact is not huge. The UK is the 5th largest economy, but it's a relatively small market for everybody except the Irish and maybe the Germans. So those economies will take a hit. That will be offset to some extent by the diversion of investment that has gone to the UK that really was intended to make things for continental Europeans. One can expect over the next few years some of that gets diverted to continental Europe. So I think the economic impact is not huge outside the UK.
Interesting. Keith, in terms of financial services, however, London, okay, UK, 5th largest economy, but London, is it the top world financial center? Certainly in the top 3. So what are the implications for banks and financial services houses based there? I've heard some people saying it might benefit Hong Kong and Singapore, for example. Is it possible to work that out yet?
I think, as I say, there's a lot of uncertainty out there. Just put some of the topics on the table. Peter touched on them in some of his opening comments. There are 2 real large things. One is London as the EU trading centre. Does that come into question? The other one is really the ability to passport within the European Union. So international banks having a trading hub or a banking hub in the UK and being able to passport into the region, into the EU as a whole. There are a couple of other things on the other side of this. It doesn't mean that those are dead, those are blown up, far from it. There's a lot of uncertainty, as I said. One is that the European regulatory framework is a relatively sensible and robust framework. I would be surprised if the UK moved dramatically away from that, and if anything, we see regulation becoming more globalized and more consistent. And to Peter's comment about the Basel Committee, I'm sure, if I was going to think from a supervisory standpoint, I'd be making sure that the UK understood that they would maintain by the rules, and I think that would be a normal expectation. So I'm not expecting there's going to be a massive change in that. The EU expects a level of equivalence if you want to enjoy the benefits of the European Union. The UK is highly likely to maintain enough of its framework similar enough to the EU to maintain that equivalence. Financial services is an enormous industry for London. So there are huge incentives for the British government. There are huge incentives for the financial community to remember what is good about London. Let's not throw the bath out with the baby out with the bathwater here. Speaking to the other side of the equation, it is difficult to find the depth of talent that you have inside London somewhere else for people to move to. You could see people moving individually and tapping pools of talent, but there'd have to be enormous changes in labour flows for that to occur, and particularly highly talented labour. And London has done an exceptional job of pulling some of the best people in financial services together in one place. Again, do I think it's a disaster has occurred or something? No, I think we've got uncertainty. There are a lot of things we do not know. We do not know about EU equivalence. We do not know about the regulatory things. It will be unlikely that we'd see fast moves in talent and so on. It will be interesting to see how the financial community feels about this. Basic things. Trading is increasingly an online thing rather than a geographic thing as well. Is it important that people are geographically based in a certain sovereign nation? Is that really a question that's important anymore? There are a whole load of things that we need to think through. And I think that we've seen a lot of emotion flowing in the market. And I think maybe now it's more the time for that thought and thinking through what this practically will mean.
Mike Spencer, from your view as an economics specialist, here we are on a hot, sunny day in Hong Kong. Is Asia looking like a pretty good bubble to be in? Is there much impact for us here in Asia?
I don't think there's a huge impact from us here in Asia, except to the extent that companies had invested in the UK unhedged and they've taken a big paper loss on those investments. We're in a bit of a sideshow. There will be, I think, over the next probably 3 years or more, a very, I think, acrimonious negotiation between the UK and the continent. I think just as the UK will want to protect financial services, you can be darn sure that France and Germany are going to want to steal as much of it as they can. And there are some things they can do, I think, to divert people and resources. From our perspective in Asia, near term, there's going to be a hit. Growth in Europe, as well as the UK, is going to be much weaker over the next 3, 6, maybe more months down the road. The more the uncertainty, the longer that period of weak growth will last, and the more that will hit exports from Asia. I don't think we in Hong Kong are going to benefit from any bad news hitting the financial centre in London. So for us, I think this is a second order issue. This is not going to be a big impact on growth here. It will be a big impact on some companies, and we're obviously seeing a lot of market volatility. But I think that dust will settle.
And except maybe for whoever wants to address this, real estate investors. There are many of them in Asia, China, Hong Kong, investing in London property. I bet a handful of people in this room have London property. Surely that's going to hit the bottom line in a lot of banks and people's portfolios.
Yeah, but just take a step back. I think the pound was kind of under 140 till some time back anyway, till 5 days back, right?
No.
So
145.
145. Yeah.
I mean, I looked at it this morning. It's been below or around 140 on a handful of occasions in the last 25 years.
If you just look back 3 months
92,
back.
2001, 2008, and now.
Yeah,
I mean,
but if you just look back 3 months back when the Fed was about to hike interest rates, the pound was about 140, right? So we've gone down to 132, 33 today. Now, is that such a big move? I mean, as compared to the morning when we woke up at 150, it's a big move, no doubt. And it was expected because the market was clearly in for a remain. Mm-hmm. Equities were up overnight. Equities have been up for the last 1 week. Gold was down. Yields were up. So it was expected, I mean, it's not such a big move if you just widen the horizon, time horizon. I don't think it's such a big move. What happens from here on is going to be more important.
Well, and I think, if I can just add to that, I think you're right, there'll be a lot of volatility. But also, when you look at the structure of the UK economy, you can say, well, the exchange rate is a good adjustment mechanism. Mind you, Britain had a big devaluation in 2008, and its balance of trade hasn't really improved at all in that period. And in the first quarter of the year, lest we forget, Britain had a 7% balance of payments, deficit. So, I mean, essentially, there is a risk. I wouldn't call it more than a risk, but there is a risk that there's a funding problem in the UK, and I think that's something that will weigh on people at the moment. All that money that's come in to buy property or utilities or whatever, If that stops flowing, then there's an immediate problem.
Yeah, they have 5% current account gap, which is the issue, right?
Yeah.
I think you've also got to temper this with the balancing effects that the market does deliver. Sure, you know, those who have been owning property, there's this rather cute video showing Peter on Twitter earlier of this panda sort of destroying a desk.
Was that you in a panda suit, by the
No,
way?
it wasn't me in the panda suit. But this sort of states, if you are a Chinese investor who bought London property at a 150 or 155, maybe you're going to be a bit peeved this morning. However, if you haven't bought assets, there are no bad assets, just bad prices. And the UK market has become very cheap very quickly if you want to invest in assets. So, you know, you would have thought there's going to be some sort of bounce back effect as money, hot money, looks for yielding assets. Remember, the FX doesn't change the yield on the asset. They look for good yielding assets and invest into that market, and maybe we'll see some bounce back from that. So I think it's really too early to tell what the deeper impact is going to be. Obviously, people will recognize higher volatility. Higher volatility demands a higher risk premium. But I'm not sure we're stuck with the decline in property prices net as a US dollar investor that you might expect.
I'm not sure if you guys have realized this, but as the conversation is going on, we're sort of tempering the risk and worry a little bit. What happens when New York opens this evening? Do you think the US, which definitely lives in its own bubble in many ways, will go, well, Trump said something nasty today? I mean, or is it going to be a shock to the stock market in New York?
Well, it's happened so many times in the past when we in Asia, we try to bring down everything, you know, with our sentiments, and then US comes and they take it in a much better, you know, economic perspective. So I wouldn't be surprised if something similar happens again. Again, you need to be aware of liquidity issues, you know, Asia time trading, US markets, and of course, you've got a much better institutional framework back in the US from institutions trying to rebalance whenever markets sell off too much on external events. So, yeah, it's...
But is this enough to temper the Fed? I mean, is this enough to keep the Fed on hold?
For the next couple of months, probably yes. But fundamentally, I think by the end of the year, the Fed will again be talking about being behind the curve and needing to raise rates. And you couple that with the central bank in the UK that probably is going to need to cut rates at least once. I think we can bounce off 130 wherever we are now, 5. I think we'll end the year a lot lower.
I really would like to open it up to questions around the room. We have a microphone, so if you'd like to give us your name and organization, that would be fantastic. Questions for all of our panelists. Who'd like to go first? Right over here in the front row.
Hello, it's Jan Eger here from Thomson Reuters. My question really, I mean, we've heard a lot about the trade effects, possible trade effects on the EU-UK relationship, but of course, what we don't have at the moment really is a single market for services. That has never been completed, and it's very doubtful that that would be completed at this stage, given the level of opposition really stemming from a handful of countries towards that. So, given that a lot of the output coming out of the City of London really is services, whether it's in the audit or financial services world, how do you measure those effects on the one hand? Also, what do you think the political fallouts will be, and in particular their financial impact then, if we're going to see possibly, I've heard rumours that EU Commissioner Jonathan Fall for Financial Services would resign after a Brexit vote, as well as key MEPs who sit on the Financial Services Committees. And I've also heard that on things like CCP recognition and questions between, in particular, the banking union and non-Eurozone members, that a lot of the concessions made, or you can call them concessions, towards London will be taken back.
I'll pick up some of that. I wouldn't want to comment on the politics, not being a Brit. But I think the challenge for the UK is that the EU has never signed a free trade agreement on financial services with anybody. So if London thinks that we can negotiate that, the same kind of access to continental European finance that we have currently, I think they're dreaming. So UK-based institutions that don't have a legal entity on the continent will not benefit from the single passport, but I suspect that most do or will. So I don't think this means a third of bankers from London move to Paris or Frankfurt, but there probably will be some, because if you're licensed as an individual in London but not in Paris or Frankfurt, it is inconvenient to travel. Somebody's going to have to chaperone you, and eventually somebody's going to say, why don't you just move? You talked about the CCP recognition. I think that is one of the clearest sort of concrete measures that the French have said they would like to do tomorrow. Now, it'll take 3 years, but I think in part of their views to negotiating this is if we're going to have derivatives traded on exchanges denominated in euros, that should be in the Eurozone, I think that's, it'll be things, institutional changes like that. I think you will see some people leaving, but not a wholesale departure of bankers. It's inconvenient, but it's not the end of the world.
Keith, Peter, any views on political implications? Are we going to see politicians lining up and resigning, major statements from European Union heads, etc., rolling out over the next 24 hours?
I'll pass on that one, I think. Again, too early to tell, but...
You'll definitely see the latter, for sure, today. Yep. From France and Germany, the EC, the Commission and Parliament, you're going to see everybody in the continent standing up and saying the European Union is a wonderful institution and those silly Brits have voted themselves out.
Yeah. In Britain, as I said earlier, I think it's very uncertain because it's not really clear who has a mandate as a result of this. You know, you can argue it from the kind of the Boris Johnsons and the Michael Goves who are on one side of it. But you can also argue, you know, it does seem like there's been a lot of traditional Labour voters who've also voted to leave, but aren't necessarily supported Conservatives. I mean, there may even have to be an election. I mean, that's all very unclear. I think what I would say, as far as the relationship with the EU is concerned, I mean, we don't really know. I mean, we're talking about unpicking 40 years of integration, and that means a lot of things are up in the air. But yeah, I think the instinct will be that, you know, where people have tried to sort of carve things out, you mentioned CCP, you know, the central clearing platforms earlier, where already attempts have been made to try and sort of bring those onto continental Europe. The UK in the past was able to, you know, through European law, resist that. Once they've left, they will no longer have that option. So they will be at the mercy, to a certain extent, of whatever continental Europe does.
Well, clearly there's a range of things to think about: political, financial, trade, etc. Gentlemen, thank you very much. Benet, Michael, Keith, and Peter. We'll keep track of what's happening, and thanks very much for sharing your views today.
Thank you. Thank you.